Drowning in dense research papers? Deep Dive is where two AIs break down academic and market research, so you don't have to. From quant finance to AI policy to economic models, we translate it, explain it, and deliver what matters. Like, share, subscribe. Knowledge should be accessible, not locked in PDFs. Fresh AI insights delivered regularly.
You know the headlines, right? All the promises machine learning is changing finance. It's the future.
Yeah, you hear it everywhere.
But let's try and cut through some of that noise today. This isn't about like futuristic fantasies. It's about real tools, real principles, and how they can genuinely impact, how we invest.
Exactly.
Today, we're diving deep into the practical power of machine learning in portfolio management. We're drawing some pretty sharp insights from the book Applied Predictive Modeling.
Great book. Very practical.
Right. So forget the idea of some kind of magic black box. Our mission here is to unpack how these techniques, when you apply them with, intelligence, can offer a serious edge in navigating the markets.
And what's really striking right from the start in the book is this point that algorithms alone, they're just not enough. They use this great analogy, the blind squirrel sometimes finds a nut.
Right. I like that.
And it's similar in finance, you see. Just throwing algorithms at these huge mountains of data might maybe occasionally highlight some correlation. But true predictive power, the kind that can consistently improve your portfolio decisions, that needs something else. Informed human judgment. That's the critical element.
Okay, let's unpack that blind squirrel idea a bit more. But for finance, we are absolutely swimming in data, aren't we?
Oh, completely.
Stock prices, volumes, news feeds, economic reports. It's endless. And the temptation, it must be huge to think an algorithm can just sort of hoover it all up and spit out winning trades.
It is tempting, yeah.
But you're saying the book argues pretty strongly that without a deep understanding of finance, these algorithms are basically flying blind.
Precisely. They're operating in the dark.
Yeah.
The book gives this really vivid example. It's about the FDA's adverse event reporting system.
Okay.
They show how a naive analysis, just looking at the data, could link a drug for nausea to leukemia. Well, simply because the patients taking that nausea drug were also often undergoing cancer treatment.
Okay. The confounding factor.
Exactly. The algorithm sees a connection, sure, but it totally lacks the fundamental understanding to see the real underlying cause, the cancer treatment itself.
That makes perfect sense.
Yeah.
So bringing it back to our world, an algorithm might flag some, minor global event as a key predictor for a specific stocks movement, when actually it's just like a random coincidence happening alongside a totally unrelated market force that's the real driver.
You got it.
So without a financial expert sort of guiding the process, steering it, the model could be built on a completely false premise.
Absolutely. And this leads us straight into that classic idea. Garbage in, garbage out. It's fundamental.
Right.
The book really stresses that irrelevant data isn't just neutral. It's not harmless. It can actually degrade a model's ability to make accurate predictions.
So it actively makes things worse.
It can, yes. In portfolio management, this means if you indiscriminately feed every single scrap of data you can find into your machine learning model, you can just muddy the waters.
Yeah.
You end up obscuring the genuine signals, the things that actually matter.
So the takeaway isn't just more data is always better.
Definitely not. It's smart data is power. Quality over quantity.
So it's less about the sheer volume, the terabytes, and much more about the quality and the relevance of that information.
Exactly.
And that's where the human element, the financial expertise, becomes, indispensable, doesn't it?
It really does.
You need someone who truly gets market mechanics, understands the drivers of asset prices, the nuances of different investment types. That person is crucial for selecting the right data to feed into the machine learning process. They can filter out the noise.
All those random market jitters, the meaningless data points.
Right, letting the real signals come through clearer.
And what's particularly insightful, I think, is the book's discussion of detrimental noise, and even what they call undesirable confounding signal within the financial data itself.
Okay, what does that look like?
Well, think about, say, a sudden regulatory change that might trigger some short-term market reactions, right?
Sure. Panic selling, maybe?
Yeah. And an algorithm could easily mistake that for some kind of fundamental shift in value. It learns the wrong thing.
But a human analyst would see it differently.
A seasoned financial analyst would likely recognize it as, probably a temporary blip and stop the model from learning these flawed relationships.
Okay, now the book also gets into something called the NVSP problem. Can you break that down simply for us?
Sure. So N is basically the number of data points or samples you have. Think rows in a spreadsheet.
Got it. Lots of data points, high in.
Right. And P is the number of potential factors or predictors you're looking at. Think columns in that spreadsheet.
Okay. N is samples. P is predictors. How does this balancing act play out when we're managing a portfolio? Is it like, does the algorithm have more questions, predictors, than answers,
No.
data points?
Well, it depends. And this is a really important point, especially because financial data is so diverse. Think about high-frequency trading, for example.
Okay. Milliseconds.
Exactly. You might have incredibly high, just massive amounts of data generated every millisecond,
Yeah,
right?
huge.
But the number of truly relevant predictors, the P, might actually be relatively small. You're focused on minute price changes, volume, order book stuff.
Right. Okay. So loads of data, fewer factors. Makes sense.
But then you flip it. Imagine you're trying to forecast, say, long-term investment returns using a really wide array of macroeconomic indicators, or maybe deep company fundamentals.
Okay. Different game.
Totally. In that case, the amount of historical data you have might be much smaller. You might only have data going back years, maybe decades, if you're lucky.
Right. Not milliseconds.
But your P, the number of potential economic indicators or company metrics you could look at, that could be vast.
Yeah.
Hundreds, maybe thousands.
So P can be bigger than N in that case. More questions than answers.
Precisely. And the book highlights that different machine learning models cope differently with these NVSP scenarios.
Ah.
Some traditional statistical models, like basic linear regression, they can really struggle when P is much larger than N. You just don't have enough data to reliably figure out the relationships between all those potential predictors.
So it gets confused.
Kinda, yeah.
Oh.
But the book points out that other techniques, things like recursive partitioning or k-nearest neighbors they mention, they can still be effective even when N is relatively small compared to P.
Interesting. So choosing the right ML approach isn't just about grabbing the fanciest algorithm off the shelf.
No, not at all.
It has to be driven by the actual structure of your financial data, this interplay between the amount of data, N, and the number of factors, P. And, okay, when we do have fewer data points than potential predictors, that NP situation, the book mentions ways to simplify things for the algorithm.
Yes, exactly. Techniques to reduce the complexity. Essentially, you're trying to narrow down the number of factors the algorithm needs to worry about.
Like focusing its attention.
Yeah, think of it as simplifying the problem, focusing on the most likely drivers without getting bogged down in, every single minor detail that probably isn't predictive anyway.
Gotcha. Now, another critical area the book really emphasizes is feature engineering and transformation. This sounds technical, but important, like taking our raw financial data and shaping it somehow.
That's exactly it, shaping it to make it more informative for the models. The book gives examples, like using something called a Box-Cox transformation to reduce skewness in the data, make it more statistically well-behaved.
Okay, less extreme values.
Kind of, yeah. Makes it easier for some models to work with. In finance, we might do similar things. We could transform, say, daily stock returns, which could be super volatile.
Right.
Or maybe measures of market risk to make them more stable. This might help reveal clearer patterns for the algorithms to actually learn from.
So instead of just feeding in the raw price change number, we might transform it into, say, a percentage change, or maybe look at volatility in a different way.
Exactly, or log returns, or other derived metrics. And the book also mentions data reduction and feature extraction techniques that use principal component analysis, PCA, as an example.
PCA! Heard of it. What's the practical benefit of something like that in finance?
Well, think of it like this. You're trying to find the most important underlying themes or factors driving the market.
Okay.
And you want to focus on those themes instead of every single tiny data point. PCA can be a really powerful tool for that. You can take a whole bunch of correlated market variables, maybe different sector indices or economic indicators that tend to move together, and condense them down into a smaller set of uncorrelated principal components.
So simplifying again?
Simplifying, yes, but in a smart way. These new kind of artificial features, they capture the majority of the overall market movement or variance.
Right.
Then you can feed these simplified but still highly informative components into your machine learning models. It can make the analysis more efficient, and sometimes it reveals underlying market forces that weren't obvious when you were just looking at all the raw data.
That's clever. Okay, but real-world financial data, it's rarely perfect, is it?
There are gaps.
Never perfect, no. The book talks about missing data and notes it's often not random, but kind of concentrated in specific places. What are some typical examples in finance?
Oh, plenty. You might see a smaller company just not consistently reporting certain detailed financial metrics that bigger companies do. That's common.
Okay, so gaps in fundamental data.
Right. Or think about a trading halt in a specific stock that creates gaps in the historical price and volume data for that period.
Yeah, you just lose that data.
And the book highlights the dilemma you face then. Do you just discard the entire data point for that day? Or maybe even throw out that whole predictor variable if it has too many missing values.
But you might be losing valuable information.
Exactly. That's the trade-off. Or do you try to estimate the missing values? Use some kind of imputation technique?
Like filling in the blanks.
Sort of. But that introduces its own set of assumptions, its own potential problems. It's not a simple fix.
It sounds like a tough judgment call every time.
It often is.
And the book also discusses how to spot and get rid of predictors that are truly, well, useless. Specifically ones that hardly ever change. They call them near-zero variance predictors.
Yeah, that makes intuitive sense, right?
Totally. If a financial indicator is basically just flatlining, staying the same all the time, it's pretty unlikely to be useful for predicting future movements.
Exactly. Why include it? The book gives some specific statistical criteria for spotting these, like a very low percentage of unique values compared to the total number of data points.
So it just repeats the same value over and over?
Right. Or a very high ratio between how often the most common value appears versus the second most common value. Basically, it's stuck.
And in finance, what might that be? An obscure economic indicator that hasn't budged in years.
Could be, yeah. Or maybe some company-specific metric that only changes very, very rarely. Keeping those in your model just adds unnecessary complexity, noise, and it can obscure the signals from the variables that do actually change and matter.
Okay, so we've talked about getting the right data, cleaning it, shaping it, making sure it's relevant. But then how do we actually know if our machine learning model is any good, good at predicting future market behavior?
The million-dollar question.
Right. The book spends a lot of time on model evaluation and this critical concept of avoiding overfitting. I guess ultimately we want robust understanding, not just memorization of what happened last year.
This is absolutely fundamentally crucial. You can't skip this. The book really hammers home the importance of splitting your historical data.
Into different sets.
Yes, into separate training and testing sets. You build your model, you tweak it, refine it, using only the training data.
Okay. Keep the testing data separate.
Completely separate, untouched. Then you rigorously evaluate how well your trained model performs on that unseen testing data.
And that gives you a more honest picture.
A much more realistic assessment, yes, of how well the model is likely to perform when you actually apply it to new, real-world market conditions it hasn't encountered before.
Because, and this is the danger, if you only test your model on the same data you used to build it,
Big mistake.
you run this huge risk of overfitting.
Right, exactly.
Where the model performs spectacularly well on the historical data, just nails it.
Well, it's amazing on paper.
But only because it has basically memorized all the specific quirks and noises and anomalies of that past period. And then it just completely falls apart when faced with new, slightly different market conditions. It's brittle.
That's a good word for it, brittle. It's like studying for a test just by memorizing the answers to last year's exam.
Yeah, you haven't actually learned the concepts.
Right. You might ace that specific test if they reuse questions, but you'll fail any new questions.
And in portfolio management, an overfit model, that could be disastrous. It might find these seemingly perfect trading rules based on some fleeting historical anomaly.
Something that's never going to happen again.
And then lead to potentially huge losses when you start using it with real money.
Yeah. Scary stuff. And the book also introduces more sophisticated evaluation techniques, like cross-validation.
Ah, okay. How does that help?
It gives you an even more reliable estimate of the model's true predictive power, especially valuable when you don't have massive amounts of data to begin with.
So instead of just one split into training and testing,
You do multiple splits. You systematically divide the data into different folds, train on some, test on another, and repeat that process then average the results.
Ah, okay. So you get a more stable picture of how the model is likely to perform on average rather than relying on one single split that might have been lucky or unlucky.
Exactly. It's more robust.
Okay. Now, the book then gets into model tuning, like fiddling with the internal settings and knobs on the algorithms. How does that relate to this overfitting risk?
Well, many machine learning models have these internal parameters, or hyperparameters as they're often called, that you need to set. Think of them as dials you can adjust.
Okay.
The book uses an example of a parameter in support vector machines called the cost parameter. Choosing these settings badly can easily lead to overfitting.
How so?
If you make the model too complex, maybe by setting a parameter too high or too low depending on the model, it can start fitting not just the real underlying patterns in the data,
The signal.
but also just the random noise. It becomes too sensitive.
So model tuning is about finding that sweet spot.
Exactly. That's the goal. Making the model flexible enough to capture the real relationships, the real signal, but not so flexible that it starts chasing randomness and fitting noise, which won't generalize to new data.
And the book introduces this interesting idea here called the one standard error rule. What's that about?
Yeah, it's a nice practical guideline. So after you've run your tests, maybe using cross-validation, and found the parameter settings that give you the absolute best performance score.
The peak performance.
Right. The one standard error rule suggests you should then look at slightly simpler models with less complex parameter settings whose performance is statistically pretty similar.
How similar?
Within one standard error of that best result. Statistically, you can't really distinguish their performance.
Okay. So why choose the simpler one then?
The thinking is simpler models are often more robust. They're less likely to be overfit and more likely to generalize well to new, unseen data. Occam's razor? Kinda.
Right. Don't add complexity unless you really need it. So in portfolio management, this might mean favoring a slightly less precise, maybe, but more dependable trading strategy over some highly complex, finely tuned model that might be super sensitive to noise or small changes in the market.
Precisely. It's about favoring robustness.
Now, we've touched on this, but machine learning models can sometimes feel like these impenetrable black boxes, can't they?
Oh, absolutely. Especially the more complex ones.
You feed in data, they spit out predictions or recommendations, but it's not always clear why. The book stresses the value of understanding how a model actually arrives at its predictions. Model interpretability. Why is that so critical in the high-stakes world of finance?
Look, in finance, trust is just essential, isn't it? If a machine learning model is recommending you make significant investment decisions, potentially moving millions.
Yeah, you want to know why.
Portfolio managers, clients, regulators, they need to have some level of understanding, some confidence in the factors driving those recommendations. It can't just be the computer said so.
Right.
So the book suggests, wisely, I think, looking at simpler, more transparent models alongside the complex ones.
Like what kind of models?
Things like basic statistical models, linear regression perhaps, or rule-based systems, things that are inherently easier to understand their logic compared to, say, a deep neural network with millions of parameters.
So there's a potential trade-off there, isn't there, between pure predictive accuracy and interpretability?
There often is, yeah. A more complex model, a deep learning model maybe, might offer a marginal tiny improvement in predictive accuracy on your tests.
Might edge out the simpler model slightly.
Right. But if you can't understand why it's making a particular recommendation, especially during, say, a market crisis or some turbulent period.
Yeah, that's when you really need to trust it.
Exactly. It can be really difficult to have confidence in it. How do you know it's not making a mistake based on some weird data artifact? Interpretability builds trust.
Makes sense. And this ties into the concept of feature selection, right? Identifying the specific data inputs, the features that are actually driving the model's predictions.
Yes, absolutely. In finance, we have access to just a vast, overwhelming array of potential indicators, factors, data streams.
Everything from PE ratios to Twitter sentiment these days.
Right. Feature selection techniques help us cut through all that clutter and focus on the variables that seem to have the most meaningful, reliable impact on what we're trying to forecast, whether that's returns or risk or something else.
And the book discusses various ways to do this, different techniques.
It does. It covers different approaches, often grouped into categories like filter methods, wrapper methods, and embedded methods.
Yeah.
We don't need to get into the weeds now.
No.
But the point is, there are systematic ways to help identify which economic indicators or company metrics or market signals are the most relevant for predicting asset prices or assessing risk. It helps build more focused, potentially more reliable models.
Okay, so bringing it all together, the book concludes by emphasizing this ongoing need for trust and continuous evaluation. This feels really important in finance because things change so fast.
It's absolutely paramount. The book underscores this critical point. Even the best, most sophisticated machine learning models are built on an assumption that the fundamental relationships within the data, the things the model learned, will remain relatively stable over time.
But that's not always true in markets, is it?
Definitely not. Financial markets are inherently dynamic. They evolve. Regulations change. New technologies emerge. New financial products get invented. Investor behavior shifts.
The whole landscape changes.
Constantly.
Yeah.
Therefore, you absolutely must consistently monitor and reevaluate your models. It's not optional.
So it's definitely not a set it and forget it kind of scenario.
Not even close. Just because a model performed brilliantly on historical data from last year or even last month is absolutely no guarantee of future success.
Things might have changed already.
They might have. You need to constantly assess whether the new data you're feeding into the model is still consistent with the patterns and relationships it originally learned. Is the world still behaving the way the model expects?
And the book mentions ways to check that.
Yeah, it even touches on using techniques like PCA, which we discussed earlier, not just for feature extraction, but also to visualize the data, to see if new observations are starting to drift outside the model's established comfort zone or understanding.
Like an early warning system?
Potentially, yeah.
Yeah.
It helps answer that question. When should I trust this prediction?
Yeah.
Is the new situation similar enough to what the model was trained on?
Okay. So really, at the end of the day, applying machine learning effectively to portfolio management,
Yeah.
it's not just about the algorithms, is it?
No, the algorithms are just tools. Powerful tools, but still tools.
It's more about this thoughtful, disciplined integration of robust data science principles, the kinds laid out in this book, with deep, practical financial expertise. You need both.
You absolutely need both. By truly understanding concepts like, data quality, that N versus P problem, the very real dangers of overfitting, the importance of interpretability, all the things clearly articulated in applied predictive modeling.
Yeah.
Then you can move beyond a superficial hype, beyond the buzzwords, and actually unlock the real potential of these powerful tools.
For making genuinely informed, more impactful investment decisions.
That's the goal.
So maybe a final thought for you listening. As you think about your own investment approaches, maybe ask yourself, what seemingly obvious financial indicators might actually be misleading noise, things you've always relied on?
Interesting question.
And how can a rigorous, data-driven machine learning approach, but one that's carefully guided by expert financial knowledge, help you uncover the genuine signals, the ones that really drive market performance?
Yeah. What assumptions are you making?
Exactly. It's a critical question, I think, for anyone trying to navigate the complexities of modern finance. Thanks for taking this deep dive with us today.
My pleasure.
Still here? Then you're not just scrolling. You're searching for substance. This isn't just another quant podcast. It's AI translating complexity into clarity, so smart ideas reach smart minds. Like, share, subscribe, join the thinkers, skip the noise. Let's make research accessible, together. Liked how that paper got decoded? We've spent 20+ years turning machine learning and AI into real-world tools, not just slide decks. Whether you want to implement a model, validate research, or build something from scratch, we can help. Explore our showcases to see it in action. Visit our site or contact us directly. Let's turn complex ideas into working intelligence together.